What if I told you the secret to long-term wealth isn't about chasing the next hot stock? It's about collecting passive income while you sleep. That's right. And no, dividend investing isn't just for retirees sipping kopi at the void deck. It could be the smartest move you make in your 20s, 30s, or 40s. Stay with me till the end, because we're going to show you how young investors in Singapore can start small, reinvest smartly, and unlock the compounding effect of dividend income, even if you're just getting started. This is Wealth for You, the channel that helps everyday Singaporeans build smarter, stronger financial futures. Hit the like button, subscribe to Wealth for You, and let's dive into how dividend investing can transform your financial journey. Disclaimer: this video is for educational purposes only. It's not financial advice. Always do your own research or speak to a licensed advisor before making any investment decisions. Chapter 1. What is dividend investing? Dividend investing is about putting your money into companies that reward you with regular payouts, usually every quarter, simply for holding their shares. Think of it like a mini bonus or a paycheck you didn't have to work for. In Singapore, these dividends often come from REITs, banks, or steady, reliable companies like Sheng Siong, which has built a strong track record of rewarding its shareholders consistently over the years. Chapter 2. Dividend versus growth investing. Which one is better? Many believe younger investors should focus only on high-growth stocks like tech giants. But while growth stocks have potential for explosive returns, they're also high risk. Not every next big thing works out. Dividend investing, on the other hand, is like driving a Toyota Camry, reliable, steady, and gets you where you need to go safely. Chapter 3. Why dividends work, even if you're young. Starting early, even with a modest amount, unlocks the most powerful force in investing: compound growth. Here's how it works. When you receive dividends, instead of spending them, you reinvest them into buying more shares. Those new shares then earn even more dividends, which you reinvest again to buy even more shares. And that cycle continues. Over time, this creates a snowball effect, where your portfolio grows not just from the stock price, but from the increasing stream of income you're building. It's how small amounts today can grow into serious wealth tomorrow, without needing you to time the market or pick the next Tesla. Take Coca-Cola, for example. An investor who bought the stock in the 1980s and held on is now earning over 50% dividend yield annually on their original cost, not to mention hundreds of percent in capital gains. And this wasn't about chasing hype. It was about consistency, patience, and reinvesting dividends over decades. So if you're in your 20s, 30s, or even early 40s, starting now gives you a head start that many people wish they had. The earlier you begin, the less you have to invest later to reach the same results, because time does the heavy lifting for you. Chapter 4. How much is needed for $1,000 a month in dividends? To earn $1,000 a month, or $12,000 a year, at a 6% dividend yield, you'd need roughly $200,000 invested. That might sound like a lot, but here's the good news. It's not necessary to start with that full amount. Start with $1,000. Start with $50 a month. What matters is building the habit and growing it over time. Chapter 5. Avoiding dividend traps. Let's imagine this. You're scrolling through a stock screener and suddenly one company catches your eye. It's offering a 10% dividend yield. You pause. That's much higher than the average. Could this be your shortcut to passive income? But here's the catch. Not all high dividend yields are good news. In fact, they can be warning signs, what investors call dividend yield traps. These are companies that look generous on the surface, but underneath, things might not be as stable. Maybe their earnings are falling, or they're paying out more than 80% of their profits just to maintain that dividend, leaving little room for business growth or emergencies. Worse still, some even borrow money to keep paying dividends just to avoid scaring away investors. That's like using a credit card to pay your bills. It works for a while until it doesn't. So how do you protect yourself? Instead of chasing the highest yields, focus on quality. Companies with steady revenue and profit growth, strong free cash flow, meaning they actually generate real cash after expenses, healthy payout ratios, ideally between 20% to 60%, leaving room to reinvest and grow, and of course, low debt levels, so they're not overly dependent on loans to stay afloat. Dividend investing is about reliability, not risk-taking. The goal isn't to get rich overnight, it's to build sustainable income that grows over time. So next time you see a too good to be true yield, pause and dig deeper. Because in dividend investing, slow and steady beats flashy and fragile. Chapter 6. Diversifying the dividend portfolio. Diversify across different sectors, banks, REITs, consumer stocks, and include both ETFs and individual companies. This protects your income and smooths out performance during market ups and downs. In strong bull markets, dividend portfolios might not be the top performers, but during downturns, they tend to be more resilient, providing stability when it matters most. Chapter 7. Why Singapore is great for dividend investors. Singapore's market offers plenty of attractive dividend-paying stocks. Think REITs, local banks, supermarkets, telcos. Many of these companies offer strong yields and predictable income. And the best part? In Singapore, dividend income is not taxed. That makes every payout go further for you. Chapter 8. Real-life purpose behind dividend investing. Dividend investing isn't just about making money. It can support meaningful goals, like helping a special needs child live independently, providing income during medical leave, or simply giving more freedom to pursue a passion without relying on a monthly paycheck. It's not always about retiring early. Sometimes it's about having the choice to live life on your own terms. Final thoughts. Start now. Reap later. You don't need to be rich. You don't need to wait until you're older. And you definitely don't need to have it all figured out. What you do need is to take that first small step. Start small. Stay consistent. Reinvest your dividends. And let time do the compounding magic. Because every dollar you invest today isn't just for tomorrow. It's for the freedom, flexibility, and peace of mind your future self will thank you for. Before you go, if this episode gave you a fresh perspective on dividend investing, give it a thumbs up, subscribe to Wealth for You, and let us know in the comments. When are you planning to start your dividend journey? Let's keep learning, growing, and building together. Because wealth isn't just for the lucky or the already wealthy. It's wealth for you. Like, subscribe, share. See you in the next one.